Hey everyone, it's Rick, former investment banker, buy-side analyst and prop trader with 25 years in the game. Today I'm combining positioning, sentiment, and technicals to hunt for asymmetric trade setups. Welcome to Offsides Macro. A qualitative but important factor in my system is understanding consensus. So by definition, I need to obviously be reading a lot and listening to the macro podcast circuit. And the one thing that's jumped out at me a lot over the last several weeks, and especially in the last handful of interviews I've listened to, is the use of the word complacency. This might sound like hyperbole, but just digest this for a moment. I'm not really sure there's such thing as complacency. And what I mean by that is I think a lot of these charlatans use that word after a particular market has had a significant move. And then it's just human instinct to usually agree when your brain sees the so-called, quote, proof of this. And then they think, oh yeah, it did seem like people were complacent. Nassim Taleb calls this the narrative fallacy because it's humans' tendencies to create what he calls simplified stories to explain complex phenomenon after the fact. But I think if you took everyone's temperature at specific time intervals and then somehow assigned a value to complacency and then plotted that on a chart over time, it just would not be a tradable indicator. Having said that, the reason I'm bringing it up is because the period that we're now in, and I've said this since April, when positioning gave us a pretty strong buy signal, that the time period right now that we're in reminds me a lot of 2023, when for the most part, other than August through October, the narrative was that this supposed big recession was finally about to come, and you continued to hear the word complacency over and over again. Now, getting back to my original comment about how I really don't think there's such thing, I think hearing that word a lot is just the ultimate tell. And the tell is anyone using that word ad nauseum. We know, whether it's a strategist who has missed a tremendous move for their clients and feels foolish, or it's an actual trader, we know that they're just way underinvested or they're even short. Now, at the risk of sounding like one of these charlatans, I will for a moment speak out of both sides of my mouth, but instead of just ending it there and then guaranteeing that you can look back and I can be right either way, right? Like saying, oh, the market's overvalued, but technically it looks like the trend can continue. Like, what the hell does that mean? I'm going to make an important positioning observation that I think we need to memory bank, especially over the next couple of weeks. On Friday, we get a headline that says Trump says the UK trade deal is concluded. The market didn't move on that. Now, I've spoken about this in the past, this concept of Trump feeling like he has room, so to speak, to talk tough on tariffs because of where the equity markets are. And I think despite all the tea leaves signaling that a deal with Europe is mostly imminent, it's certainly plausible that Trump won't give the EU a single basis point leeway on a tariff deal, because we've heard from him for literally over 3 decades that he truly believes in his DNA that the EU was created purely as a way to, quote, screw the US. And given this so-called room, I think there's a reasonable chance for a small scare and a risk-off environment to come. Now, here's the difference between me and the other macro podcasts, is that I'm going to make a positioning observation that you can actually memory bank and maybe trade. I've said this for months now, that the equity positioning continues to be reasonably net short, and that's still the case. In fact, the positioning week over week got even more short, especially in the S&Ps and the Russell. Now, I think we need to memory bank where that positioning is, because if we do have this pullback, if you're going to try to catch anything in a risk-off environment, I think you want to take a look at the S&Ps and especially the Russell. And lastly, here's a quick clip from a podcast that I did about 2 weeks ago on energy. I want to play it for you. It's brief, because even though energy has faded around 1.5 days worth of vol since I made that comment, the group as a whole has come off quite a bit positioning wise, but heating oil remains aggressively offsides long. So that's something also to memory bank for a possible sell the news trade if we ultimately get Russian oil tariffs. I just want to highlight one quick observation that I think could be setting up for a trade over the next 1 to 2 weeks. Energy as a group, excluding natural gas, has slowly crept out of the lower quartile since the beginning of June and is now entered into the upper quartile. It's officially offsides long if you just look at WTI and heating oil. And we learned late this week that Saudi Arabia is asking companies that OPEC uses for independent analysis of oil production levels to submit a lower figure for the kingdom's output numbers. And they want them to use actual delivered versus pulled from the ground. And it looks like they're trying to manipulate how the oil output is counted so that they can hide overproduction. So I think that's reasonably well known at this point. The CTAs now are long across the board. They were long WTI and heating oil, and it looks like they just recently flipped long RBOB. And then we also have whiffs of Trump possibly putting further sanctions on Russia. And I want everybody to just be aware of this for next week and sort of memory bank where the current energy positioning is for a possible sell the news trade. You'll hear me use the term offsides quite a bit. I've written on this extensively, but consider it in the context of a sports analogy. Being offsides is not a place you want to be. Lastly, for the best experience, I highly recommend you open the deck listed in the show notes. The charts and tables that I reference will help you fully connect the dots. So let's hit the deck real quick. You can see that I've made 5 key observations here. The first is in the equities, and they continue to be shorted / underweight, with the exception of the NASDAQ. The S&Ps and the Russell are both at nearly pinned offside short, and you can see that in the charts below. The metals have now entered into the upper quartile, and if you're looking to short any metals, I think palladium is the most interesting, and we'll get into the seasonality on that in a moment. I mentioned the energies earlier, so I'm not going to go through that again. The developed market FX is something that I've been repeatedly talking about, and this developed market FX indicator that I've created, which weights positioning relative to the Dixie contract, it continues to leak lower. So it's now at the 80th percentile from barely above that last week. And the euro remains the most extreme offsides long. And lastly, circling back to a market that I highlighted maybe over a month ago, the softs remain very shorted / underweight, and you have most extreme shorts in sugar, cocoa, and coffee. Now, if you look at the next section, I went ahead and I put together a very short deck on the seasonality of the current markets that are offsides. And I never explored this until now, but I think there's some very interesting observations to be made on markets that have seasonality that's pretty clear directionally and also aligns with offsides positioning. I think the most interesting there are the markets palladium and especially the softs, sugar and coffee in particular. So check that out when you have a moment. If you scroll down into the deck, the first section with the charts, you'll notice that I typically start off with the equity markets. You can see that the S&Ps, the Russell, and the Dow are all very shorted, underweight. The NASDAQ is the outlier there. The next section is the Dixie weighted developed market FX oscillator that I created, and you can see some highlighted FX markets like the euro, the New Zealand dollar, and the Canadian dollar. Next, just for your reference, I talked about energy before. You can see WTI is sort of nowhere now, but heating oil, as I mentioned earlier, is very extended offsides long. The palladium chart, if you continue scrolling, you can see there. Next, we have a possible pair setup in soybean meal long and soybean oil short. You can see the positioning is offsides in both of those instruments. And then lastly, this is going to be a pretty big focus for me over the next quarter, are the softs. I think sugar, cocoa, and coffee are very interesting. The next section is what I always include in my decks, which is what I call the zeros and ones. And you can see where the positioning is for every instrument. You can see which instruments are in my offsides positioning index in the OPI column. And I think it's also very interesting to track what the trend CTA guys are doing. So that SG trend indicator column is how they're set up. They're very long equities. They're long the entire curve with the exception of the long bond. And they remain very short US dollar, long metals, short the softs. Last section is the OPI, the offsides positioning index that I've talked a lot about and I've done a primer on. And you can see that it had a really great start to the year up until about mid-May. And then we've just been fading. And a lot of that has to do with the FX markets. I've been collecting quite a bit of statistics on the OPI, and I'm actually considering, after year-end, writing some sort of white paper on my observations. I think that might be a pretty interesting read, but we'll see what happens there. Thank you for coming to Offsides Macro. The views expressed are my own and do not represent the views of any employer or affiliated institution. Nothing discussed should be considered financial advice. This content is for informational, educational, and entertainment purposes only.